This is Shekhar Bajaj. Good evening to all of you, and thank you for being there for this conference call. You must have gone through the press release and the results. So I think we are reasonably satisfied with the performance of the consumer business. I mean, to have a positive EBITDA in spite of the sales being down by 50% shows that once our normal business comes up, then we should be in a very profitable state. One of the good news is that our first level margins for this quarter compared to June quarter of last year is higher by about 2% plus. Only because our turnover is down, and therefore to that extent our profitability has got impacted, but that is something which was expected. In the month of April it was 0. In the month of May it was about 50%. And the good news is that in the month of June, we've done over 100%. That means more than June of last year. And July also is almost equal to the previous year, in spite of all the closures, all the slowdowns, all the lockdowns. In spite of that, it shows that once this thing gets cleared, then the future in the season time, we can expect to grow much better. And therefore, our internal objective is that though we've lost 1.5 months because of this COVID situation and lockdown situation, we hope that last year we did about 2,900 crores, so we should do around 3,000 crores in the current year also in the consumer business. In the EPC business, strategically we had done last year against 3,800 crores, we had done 1,900 crores. This year we are still got a good order book, and therefore we still hope that in the next 3 quarters we should be able to catch up and end up around last year's level, maybe 5% lower, but we will not go higher than last year. So we hope that against last year's 4,900 crores, we should do around 5,000 crores in the current year also. The other aspect which is most important is during this period, normally a person would say that, how can I collect money, everything is closed down, but we are happy to inform you that we were able to collect substantial amount of money, and 145 crores further cash flows have improved, and therefore our debt has been reduced from a 2,000 crores previous year to we had done 962 crores end of March last year, and by end of June we have now reached a level of 810 crores, and therefore our interest cost against 49 crores last year, this year it is only 26 crores, which is a reduction of almost 50%. So our interest cost has gone down by 50%. We are hoping that the interest cost in the coming quarters will be even further lower. So against the 170 crores, that was our total interest cost for the last year, full year, we expect that it will be below 100 crores in the current year. As far as EPC is concerned, the overall costs are continuing because our business has substantially come down. Even last year it was 50% of the previous year, but the first quarter is even more than 60% lower. Of course, April, May was completely almost 0, and June also is not picked up as well as we can because number of sites and all have not given us time for execution. So EPC will take its own time, but as long as our monies are coming in and we are really improving our cash flows, that is most critical. So we are very positive and very happy about the performance that has happened, and I would now request Anuj Podar, our Executive Director, to add some points to this. Thank you.
Thank you, Mr. Bajaj. Good evening, everyone. This is Anuj Podar. I think he's covered all the points, not much to add, just a couple of things that I'll emphasize and just add to. One is, like he said, we've been, I think I'm fairly satisfied with this quarter, particularly our consumer business and the bounce back in the consumer business that we've seen, particularly in June. I think a lot of that I would credit to our team's ability to respond dynamically to the evolving situation. It has not been easy. We've had many challenges on supply chain, on logistics, on warehouses, on factories, etc. But we've continued to respond to that on a week-on-week basis to deliver the consumer business revenue. The part that he mentioned about the first level margin expansion, I think that is critical. Like we've been saying, our longer term focus is to drive margin expansion for the consumer business. So we've driven a more than 2 percentage point gain at the first level margin. The bottom line, it's not translated because of this quarter, as you would understand. But going forward, I think that should hold us in good stead. On the EPC, it has been a challenging quarter on execution and billing because that is very labor dependent, and therefore, unless the movement and availability of labor normalizes, I think that may stay a little bit under pressure. What's helped us contain the impact of this at the bottom line and deliver positive on the consumer and also contain a little bit of negative on EPC has been a focus on cost. So besides driving cash flow focused, which Mr. Bajaj spoke about, we've been very focused on controlling our costs. If we look at it, overall, broadly speaking, our costs are at sub 50% of last year, but that includes a cutback on variable costs, which anyway would come down, but also many other so-called fixed costs, which we've aggressively looked to contain. Going forward, our intent is not to come back to full cost levels. So wherever cost savings can be continued going forward, we are also focused on getting the advantage of that for the rest of the year so that we partly make up for the losses of the first quarter on a bottom line basis. So I think I'll pause here. Some other comments I can take up later based on the questions. Thank you very much.
Also, I'd like to just mention that our director, my daughter-in-law, Pooja Bajaj, she's also going to be available. So she would like to learn. So she is also there with me during this conference call. Thank you. Now we can have it open for question answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1 on your touchtone telephone. Participants wish to ask questions may press star and 1. We have the first question from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good evening. Thank you for the opportunity. My question was, sir, can you give some color with respect to the ECD business in terms of appliances, lighting, fans? What has been the decline?
Sure. Achal, so this is Anuj. I'll give you the percentages, but frankly, I think the comparison doesn't draw that much meaning. Lighting is down by about 40%. Everything is Y on Y.
Right.
Appliances down by about 53%. Fans by 50%. And Morphy Richards by 51%. But qualitatively speaking, I think we've seen buoyancy in the appliances, particularly kitchen appliances, and we've seen a reasonably good comeback on the fans category. Coolers performed below what we would have expected, even in terms of comeback. And lighting, we, unlike the rest of the industry, we had a growth for the last few quarters, but obviously this quarter we did not see that growth in lighting.
Right. And you touched upon the margin expansion, the first level margin expansion by about 200 basis points.
Yeah.
Now, is it driven by the a price increase, or is it driven by the product mix in terms of premium and non-premium? And is it also to do with the product mix, in terms of the individual category mix?
So this single largest component of that has been due to price mix. Having said that, we have been premiumizing certain product categories and doing that, but at present in this quarter, I think the bulk of the contributor has been price increase.
And what is
and just FYI, the price increase is obviously not taken in this quarter, but it was taken in the middle of last year. So the last year's quarter it was taken after June quarter of last year.
And would you remember what is the broad increase at the aggregate level? Would that be...
So the broad increase on a very generalized average basis would be between 2 and 3%. Obviously varies across certain product categories. There is certain cost increase also in some categories, but the rest of it is coming through some of the smaller other contributions. But broadly it is price increase, average between 2 and 3%.
And what is the mix now in terms of the premium? If I have to look at last 12 months, what is the mix for us in the consumer product business from premium category?
So to be honest, that's a very qualitative definition of premium. So we don't define it as premium versus not. Just directionally, for example, fans, as you may know, we've always been more focused on sub-economy and economy. We did launch premium fans towards latter half of last year. Similarly, individual models we've been plugging in the premium category in mixer grinders or other appliances. But holistically as a company, we don't have any premium versus non-premium bifurcation as such in sales.
Got it. The other question, if I may ask, with respect to the EPC business, now can you help us with respect to the receivable as of 30th of June? At the total and breakup in terms of EPC and consumer products?
So let me bring in our CFO, Mr. Purandre, who's on the call.
Yeah. Total receivables at the company level is 2,300 crores.
Okay.
Out of that, EPC is 1,843 crores.
Okay.
And 459 crores is for consumer durable. Which is obviously a gross figure. The channel finance, which funded by channel finance, is 287 crores.
That's part of the 453 crores, right?
Correct.
Right. And within the EPC, would it be possible to give some color as to, how much is retention money out of this? Could there be a risk in terms of provisioning of these given the way payments are getting delayed in general from the government institution?
See, out of this 850 crores, around 660 crores is a retention money, which is obviously receivable after the completion of projects. And as far as provisioning is concerned, as you know, we already have the very robust provisioning policy, which is, I think, more of stringent policy for the provisioning. So whatever we feel that is not collectible, we regularly take the provisions for those. So whatever receivables, what we are showing in these books, they are all collectible.
Right. Just one more question actually with respect to this. Based on the current assessment in terms of the situation, do you see a possibility of any substantial provisioning for these, out of the EPC receivable in balance 9 months FY21?
At least we don't see that kind of a risk because most of the clients are government clients. And there may be a delay in getting the payments, but there is no risk of writing it off these receivables.
Got it. Great. That's really helpful. I'll come back in the queue for further questions. Thank you.
Thank you. The next question is from the line of Avnish Agarwal from Prabhudas Lilladher. Please go ahead.
Yeah, hi sir. A couple of questions from my side. First, I just missed on the number that how is the sales recovery happening in the month of April, May, and June, and how confident are you of sustaining this trend in the coming quarters? This is my question number one.
Thank you, Avnish. So, our sales in April was 0. Our sales in May was approximately 50%, and our sales in June was approximately 104% of previous June. So therefore, on an overall basis, it kind of averages out at about 50% of the previous quarter. The good news and the bad news on this. The good news is that, let's take the June number, that is despite the fact that all of India is not open even in June. We had many markets, including urban metro markets and areas that, while technically they may be called open, but actually they were shut down to various extents, etc. So not all restrictions have been relaxed. So, sales revenue has been despite the market not fully being open. The July situation has been slightly worse in terms of sporadic local lockdowns, which has started to affect supply for us more than really demand. So the good news is we're seeing a demand bounce back more than just pent-up demand. I think there is a certain amount of, buoyancy, or at least a certain amount of comfort that the demand has not been, has not evaporated. But supply really is a concern because of the local lockdowns. I remain hopeful that, another few weeks or end of August or by September, supply issues also should sort them out, assuming that we don't continue to have these lockdowns, in which case I think the rest of the year should be good for us. Yeah.
I would like to just add that in spite of these problems which we are talking about, July was not as good as we would have liked it, but it's almost equal to last year's July. So to that extent, it's satisfactory. But because of the slowdown and because of the lockdown in various areas, we would have liked to start our growth in July, which is not taking place. That's why he says not satisfactory means from the angle of our own internal, because we have to make up for what we lost in April, May has to be made up. And therefore, we wanted to start after June being 100% plus. We wanted July onward to be 100% plus, so which did not happen, but we have reached almost a July level, which is the good news.
Okay. So my second question is, you indicated 2% margin expansion at the first level in consumer business. So can you throw a little bit more light on what is exactly this 2% expansion at the first level, and what sort of a trajectory you are looking in terms of margins over the next 2-3 years?
So I did share that in the previous one, that margin expansion has come largely due to price increase that we had taken last year. I think it was around July, August that we took the increase. Going forward, what we expect is a 1 percentage point increase on an operating margin for consumer segment per annum. That may be slightly lower in the first couple of years and higher in the later years. But what we're also looking to do over the next 2-3 years is invest in certain areas. When I say invest, that's in product, in R&D, in quality, and in brand building. And all of these investments should be self-funded. So some of the first level margin will be reinvested in product and R&D. And similarly, some of the margin expansion or savings that we'll drive at overhead will self-fund the brand building activities. So we want to invest in these things to drive future longer-term growth, but without actually impacting margins, and hopefully actually continue to expand margins while yet doing these things.
Okay, sir. So just a final bit from me is on the EPC business. Now the EPC business, I would say, like one is your transmission line towers, and we are having this year lighting projects and your rural power distribution. Now, in particular, if we have to dissect each of these businesses, which are the sustainable businesses of the company in the long term, and do you have at any stage any plans to exit your transmission line towers or the rural power distribution business?
So if you see FY19 versus FY20, in FY19, overall EPC business almost 2/3 of the company, and even within that, your power distribution is a dominant share of almost 2/3 of total EPC business. So we've significantly changed that. Overall EPC business has come down to 1/3, and within that, each of these three segments at a very broad level are 1/3 each. So we managed to contain the power distribution business, which was causing a certain issue at that point of time. Now going forward, we do not expect to significantly descale this business, but like as the chairman said, we will probably contain the business more or less at these similar levels. We are continuing currently to bid for transmission line tower businesses. The illumination or lighting business is a general ongoing business, so that anyway continues. The power distribution business, as of now, our hands are full in executing the UP and the non-UP order book. As and when that closes down, then we will take a call on what is to be done.
Okay. Any plans in the longer term to demerge your EPC business?
No stated plans as of now. I think we are more focused on handling the current projects rather than taking a call on that or doing anything about that.
Okay, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi, good evening. I have a few questions. First, I missed the initial opening remarks. So if you don't mind, can you help sharing how was the broad growth rate within the ECDs across different categories?
Yeah, so that's within consumer, right? So, Renu,
Yeah.
good afternoon. This is Anuj. So, lighting has degrown by 40%. Your appliances has degrown by 53%. Fans has degrown by 50%. And Morphy Richards, which is much smaller, has degrown by 51%. That's a quantitative answer, but more qualitatively speaking, we continue to see good traction on appliances, particularly the kitchen appliances. The cooler business is the one that was slow to come back, and we've seen good traction on the fans business when the markets opened.
And what is the kind of inventory are we stuck with in the cooler business?
Mr. Purandre? So I don't, okay.
Do we have any inventory which is stuck with the company in the cooler portfolio? Everything has been parked with the dealer distributors.
No, so we do have cooler inventory stuck with us also. It is not as substantial as some of our peers, I won't name them, but who are cooler focused otherwise. But yes, we do have cooler inventory. I think that's unavoidable there.
Correct.
I think the good news for us is because we are a diversified product category business, that doesn't have an overbearing impact on our balance sheet or other issues. So it's something we're not overly uncomfortable with there.
Right. So second was a bit on the EPC side of the business. So if you look at the entire portfolio, obviously there are execution headwinds as well. So how should we look at the current order backlog that we have and the completion timeline of the rest of the UP project, including add-on jobs? And how should we view the payment timelines, including release of retentions from the state?
So I'll let a CFO answer the receivables and payment, but before that, just in terms of execution, I think COVID has impacted EPC more because it is labor dependent, and labor needs to move across districts or states to execute some of this work. So to that extent, that's why EPC you see is more impacted than consumer is right now. Okay, yeah. It is yet not gathered full steam right now as we speak, but we are on that job. In terms of this order backlog or otherwise UP business, there continues to be certain incremental work, which is called phase 2 or phase 3. To some extent, the good news for that is that helps us to continue to, because the incremental work all is at incremental margin compared to earlier work that we've done. But we yet want to do finite amount of incremental work, not chase that margin unlimitedly, number one. One of the issues that is coming up more recently is in the transmission line business. The order book growth is slow right now because the new projects that are coming up have slowed down in terms of the government or Power Grid or others issuing fresh tenders.
Yeah.
The China issue, some of the tenders that were issued or were in WIP stage have been cancelled because the respective entities have revised the tender conditions to exclude certain China originated materials.
Yeah.
To that extent that those tenders are being reopened, refloated, and therefore rebid for. I don't think that changes the dynamic of that business, but does delay some of the billing or the order book closure or the tendering closure for 3 to 4 months. So I think to that extent there may be a slight slippage on what we had anticipated for this year on our TL billings there. We'll see how that goes. It's a little early to say how much of that delay will be. We'll catch up on an accelerated basis or may have a 1 or 2 months delay in terms of actual, the entire process.
Sure. Is Mr. Pandre sir just clarifying on the amount? Yeah.
Yeah. So, see, as I already said, that total outstanding for the EPC is 1,843 crores.
Yeah.
And out of that, 660 crores is the retention money. Obviously, this retention has a different maturities because some of the projects of rural electrification in Bihar, MP, they already on the verge of closure, or some of them are already closed. That retention is around 250 crores, which is obviously collectible as soon as we complete everything as far as financial closure of the project is concerned. The 200 crores retention is for the UP projects, which is obviously going to take a little more time because we are not yet closed all the projects in the UP. So it will have some lag effect. And the remaining retention money, which is for transmission line tower and illumination, is around 190 to 200 crores. So out of which part of this will come in this financial year, and remaining will go to next financial year on the basis of how the projects are getting completed. So that is the overall retention collectability.
Right. And then broadly the last question on the consumer part of the business again. Probably yes, we continue to see those erratic or cyclical lockdowns impacting supply as well as demand. But as we move towards the festive season, what is the broad understanding based on feedback from channel partners and your secondary sales data points that you track in terms of demand offtake? Should we expect normalization by Diwali, or you think for the business to normalize could actually take longer in terms of the timelines and activities?
Renu, so let me answer that from the demand side. I think demand yet remains very buoyant and strong. Okay, so I don't think now we are that worried about demand. On the supply side, I also don't believe that lockdown can continue for so long. So I think the governments, even local level governments, are under pressure to allow for the activity. I would yet think festive is a couple of months away, and we should start, normalizing by that point of time. Having said that, the slight issue there is on, just the logistics of this, because for supply sales to happen at a retail level, actually the channel filling needs to start happening in August. Okay.
Right.
So to that extent, if you're 1 month delayed also on the production kicking in and the movement of goods, we have to see how much of it we can accelerate in terms of channel stocking, etc. But yet on the broad level, I remain optimistic. Just one more data point for you. I think the driver of sales right now is the general trade channels, which is small stores, and the e-commerce platforms. The modern retail yet continues staying under pressure. I think that trend may continue, but I think that is being more than made up by the other two channels. So consumers, if they need a demand, they don't care. They will go to the other channel where they're comfortable, and the demand only shifts between channels. I don't think it disappears on a particular channel because of channel being weak here.
Right. And if I can ask one last question, Bajaj Electricals as a company, we have fairly strong reach in the tier 2, tier 3 and interiors of the country in terms of distribution and reach. If we see the feedback from some of your other peers suggests that those who are not focusing as much on these part of the market, they are actually now taking up efforts to increase the distribution in the smaller towns as well. So do you see competitive intensity for your portfolio and your market increasing there in terms of other brands being fairly available in markets where the availability was not there? And also, would you perceive any price pressures or otherwise in the segment of the market for you?
So, maybe yes. So, all these guys will go there too, and, there's nothing to stop them. So, we would
because this is the market which is actually driving demand in the current environment as petrols have dried up in terms of broad uptake.
Yeah, but I'm saying, yes, they will all go there. I mean, it's a natural, part of progression. So, I would be naive to imagine that they will not go there. But my optimism stays on two fronts. One is, irrespective of them, I think there is a greater shift between unorganized to organized players and unbranded to branded. So I think that is in our benefit. And number two, I think today the driver has been the rural or the smaller towns because of greater level of lockdown in the metro areas. But for our kind of product categories, I don't think metro demand is, not there. And therefore, as the metros also open up or the urban areas relax the the restrictions more, I think that will also come back strongly by the time of the festive period. So I would not overly worry about competition of ours getting to rural because I think we have other positives in our favor.
Renu, I would like to add one more point that because of our distribution and not having any wholesaling, once these wholesalers open up in the metro towns, whenever distribution has been done by us in the rural areas, one of the things was there was no problem of any wholesaler going and disturbing that market. When competition is going to go to those rural markets, the wholesaler will always create a problem there because the wholesalers will always go there. And to that extent, for them to stabilize in the rural markets is not going to be easy. It took us a long time ourselves. So, of course, they can do it, but it will take them a couple of years. It's not that they just say, okay, now the rural market is opened up, so let me go to the rural market, because the wholesaler comes in, he'll immediately go and spoil that market. I thought I would add that. Okay?
Right. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Hitesh Tao from ICICI Direct. Please go ahead.
Thank you for the opportunity, sir. Sir, as you mentioned, the metro region is opening now, and you you expecting a kind of good demand recovery from that segment. Sir, could you just quantify how much is the metro region is contributing as of now in the sales, sir, in the EPC, in the consumer segment?
So Hitesh, to be honest, we don't, it's very hard to track, and we definitely don't reveal that because we have broad numbers internally for urban versus rural, but there tends to be a certain amount of cross-pollination the way it exists. So it is not very accurate, and therefore we don't publish those numbers here. But just to give you a qualitative sense, rural has, based on whatever parameters or level of accuracy we have access to, rural has grown by about 3 to 4 percentage points compared to 1 year ago for us, the sales contribution.
Okay, that's it, sir. That's
just to give you a little more insight, but urban yet is 2/3, rural is 1/3. But don't take that very literally. There is the margin of error in that is wide for the reasons I gave you.
Okay. Also, it's very difficult to decide what is rural and what is urban. Where is the cutoff? I don't know really. When somebody says 2/3 is urban, is Raipur urban or rural? We don't know. So therefore, unless somebody defines and says, because in our case, one good news is that we know exactly. If you give me that these are the towns which you are talking about, because there's no movement from one area to the other because there's no wholesaling. While in earlier cases, if Bombay was selling 100 crores, out of that 100 crores, maybe 30-40 crores was going outside Bombay. And therefore, to that extent, whether it was a sale of Bombay or was it a sale of upcountry, it was a confusion. Now that confusion is not there. Whatever we are selling in Bombay is only for Bombay, and whatever is being sold in Raipur is only for Raipur. That's the only thing. So we are aware. But where is the divide? How do you call rural and what is called urban? What is called semi-urban? We don't know really. So therefore, we are only keeping a track that each area wherever we are selling, are we having the required growth compared to what it was being sold in that same territory in the earlier period. That's all.
So, urban means generally I wanted to know about the metro region which were under the lockdown and have opened recently. So any which ways, that's a fair thing Mr. Anuj has mentioned. It's okay. Now, sir, my second question pertains to our e-commerce channel. Sir, how has been the growth through that channel in our sales for the quarter or for the year? If you can just throw some light how the sales is moving through the e-commerce channel.
So, Hitesh, again, 2-3 points. Number one, I think the driver channels for us right now and through the rest of this year will be e-commerce and will be general trade. And what is going to lag is the modern format retail as well as the government channels such as CST, etc., etc. Okay. In terms of e-commerce growth, despite what you read in the media, it is not that aggressive, not for their fault. I think consumers are and behaviorally will go towards e-commerce. But if you recall, during April, May, even some parts of June, there were a lot of government restrictions on e-commerce platforms being allowed to sell what is called non-essential goods. So the trade shops were allowed to open up much before e-commerce was allowed to sell. And to that extent, we did not get the bump up as much in Q1. But in July, once all e-commerce is functioning fully, we are continuing to see the bump up in e-commerce sales, and that is continuing to now grow faster than any of the other channels there.
Fair enough, sir. So my last question pertains to our advertisement expenditure, which obviously would follow the demand scenario.
Yes.
Recovering the demand. But could you throw some light how should it be? How would we be going forward for the rest of the year?
So we have generally guided in the past, I don't know which ones you may have attended, that historically we've been in a 3.5 percentage point spend ratios of percent of sales, which we consciously intend to up to about 4.5, maybe up to 5%. There will be a little, range over there. Because our sales this year will be lower than what it would have been in a COVID situation, obviously the ad spend will also correlate to that, so we'll always operate in the percentage zone over there. Okay. What we've done right now within that is also temper that on a quarter-by-quarter basis. So this quarter we did pull the plug significantly right since middle of March on ad spends that we had otherwise planned. You must remember summer is a big quarter for us. We do have many product categories. I've seen some of the competition numbers, but we did not choose to go zero fully on summer because fans and coolers we needed to push out, and therefore we did choose to advertise. But though we had initially expected to increase over last year, we've ended up, I think, at about 60% or something of last year's June or Q1, ad spend. Going forward, the ad spend on a Y-on-Y basis will be higher, but it will remain within the percentage range of sales, and therefore should auto-correct based on how we see the demand play out. We will keep calibrating our ad spends on that.
Okay, good. So my last question pertains to the debt level. You mentioned it is around 800 crores. So just wanted to know, is it a gross debt?
Let me bring in our CFO, and it's 810.
Yeah, it's a gross debt.
It's a gross debt. Thank you, sir. Thank you. That's all from my side.
Thank you.
Shall we move to the next question?
Yes, please.
The next question is from the line of Akshay Bor from Premji Invest. Please go ahead.
Hi, thanks for the opportunity. I want to understand on the EPC business, any paths to profitability, how many quarters down the line do you expect us to break even there? And within that, if you could give us a sense of the underlying margins for the three different businesses, lighting, TLT, and PD, that would be helpful. Thanks.
Thanks, Akshay. So, let me take on from the second perspective. I think illumination and TL, we do expect to turn around this year and deliver overall operating level profitability. Power distribution may remain a challenge at an operating level because of, I think, just the incremental work that we're doing this year. If you look at that on a marginal basis, that will be profitable. But because we have the lag of the larger bulk sitting behind that, and more than that, the impact of the larger overall cost structure, that is why I think power distribution will continue to be loss-making this year. I think the challenge between that is to differentiate between the project or execution level profitability versus overall. I think the only way the overall profitability in that will kick in once we're able to, we've descaled the revenue or size or quantum of work, once we're able to descale the quantum of our overall infrastructure or establishment costs, their overheads. I think that will be completely back-ended to when we are coming to closure of the projects that we can, take care of that piece. We had originally targeted for March 21 quarter to be profitable at an exit quarter. Maybe one quarter at worst, I would expect that delay on that because of these COVID and other recovery rates.
Understood. But in terms of, let's say, FY20, how would your profitability be, in lighting, TLT, and PD?
FY21, you mean 2021, right?
2020, last year. Last fiscal, how was the profitability split up between?
Okay, so we don't disclose in that, Mr. Puranday, you want to shed any light, but we disclose it at an EPC segment level and not at a breakup.
Yeah, because overheads are common. It's allocation of overheads.
Understood.
Yeah, but I can just share with you qualitatively, Akshay, that these were marginally not profitable, not high losses, but we intend to turn that around this year. So from an internal tracking perspective, they should be profitable this year. That's the TL and the lighting or illumination.
And just trying to understand the cost structure a little better here. The employee spend especially is flat year on year despite the decline in the revenue, and then any other heads that you see as potential areas where we could get some cost savings.
So employee, the reason you see flat, actually our normal increment cycle kicks in Q2. So last year, July, August, when the increments had kicked in. So June was flat, and therefore what you're seeing this year's June is with that increment baked in. So over last year's June or Q1. So with the increment, it is yet flat because we, on the other hand, had certain attritions or reduction in overall manpower. You will see more benefit of that play out through the rest of the year. So Q2, Q3, you will see a decline Y on employee cost front. So I've seen some of the other competition numbers. They see a decline in Q1. I have a view on how Q2 will pan out for them. But rather than comment on that, let me just say Q2, Q3, you will see a decline for us on employee cost numbers. On the rest of the costs, like I've shared on the call, we are continuing to look at a lot of these overhead cost numbers on a normal basis. We have, achieved certain savings on Q1. Even as business normalizes a comeback, we do not want to surrender all of the savings, so we'll continue to see how much savings we can continue to optimize going forward here.
Understood. And just one last question on the consumer side. If you can share what's the share of e-commerce at this point, and also in terms of inventory in the channel. I understand you operated a minimal inventory, but at this point, what would be the overall inventory in the channel? Share that. Thanks.
So, Purandre, do you have the e-commerce number? So, this Q1 is little enough aberration to, dissect that, but I think it would be between 12 and 13%. Purandre, Rakesh, can you confirm that on the e-commerce? I think exit run rate for the month we are coming there. We did, Akshay, I don't know if you're there in the earlier parts of the call. Why I'm saying it's an odd quarter because April, May was suppressed, and therefore I don't want to use a quarter-wide percentage to measure e-commerce there.
Or last year is also fine.
Last year used to be about 10-11%. So normally it used to be 10-11%. We are seeing that inch up by, so I would think by quarter 2 that should be about 13% or so, give or take. Yeah.
Understood. And inventory in the channel, any comments?
Inventory has come down, so because the supply has been constrained, but at the same time our demand fulfillment has helped us bring down overall inventory for consumer products. I'm talking our own inventory, plus of course the channel inventory. So to that extent, we are not overstocked on inventory on. So this, if there is further demand and if we are able to supply, I think inventory is not overbearing for us.
Thanks. That's it.
Is that fine? Deepak, you may move on.
We'll move to the next question. The next question is from the line of Rahul Gajre from Haitong Securities. Please go ahead.
Yeah, hi, good evening. Most of the questions are answered, but I thought, I understand, this quarter has been tough on business, but I wanted to congratulate you on the balance sheet improvement that you all have done. Now, when I see your improvement in the cash flows that you've done, I obviously see that a large part of that cash flow improvement has essentially come out of capital employed out of the consumer business. And I think, like you just mentioned to the earlier question, given that inventory has come off, do you see that this inventory which has been scaled down will go up, and therefore there is a risk or there is a chance that the capital employment benefit that we have seen in the first quarter will actually wane in the second quarter? Is that something that you think is a possibility?
I think that's a very fair question, Rahul. I think this 145 crores is not sustainable in terms of extrapolatable, the Q1 numbers. It has been heightened or increased because of the reduction in capital employed in the consumer products business. Okay.
Right.
As we stock up for the festive period, you will see an increase in the capital employed or inventories, etc., for the consumer business. Typically, we do have seasonal, swings to that extent. I think the CFO can share. But also, it's not completely out of pattern. So typically, you stock up pre-summer, then you do have some of this, pullback on inventory, and then towards the end of the year, you again stock up. The CFO can confirm exactly. But yes, you're right. So that swing factor is there, and to that extent, there will be. I don't think that means we'll go into negative cash flow. It's just that you will not see a 145, extrapolatable there.
Let me also add that I personally think that though this will happen for consumer products, our EPC area, I think we will, first quarter was not too good in terms of collection, but the feedback which is coming is that second quarter we may have some better compared to our billing, the collection may be better. So overall our capital employed may not go up. It may not go down to 155 crores like it's happened, because now consumer business will not give you any more further benefit. It may go a little negative. So, but there'll be sufficient positive cash flows coming in because of EPC business. So overall, I think we should be at the first quarter end level at 800 and odd crore. Should be the similar levels we should be continuing in the second quarter also.
Just, Rahul, if I may add to that, so I think the chairman is completely right. So, that's the way it will play out. We do expect to have more collections on EPC in Q2, but the billing in Q2 will continue to remain slow, execution will remain slow because this is the monsoon quarter. So typically EPC has low billings and revenue in Q2. Q1 usually is an important quarter, so to that extent we missed that because you try to get a lot of work done before monsoon. So endeavor yet remains to then make up for that in Q3 and Q4 in terms of execution revenue. But the cash flow clearly, to repeat, will continue right now also.
In the press release, you've also, made a comment, that most of the sites are up and running right now. Given that monsoon typically, like you just said, that execution is slightly slower. So in terms of execution, how do you see this? You don't have a problem with labor and all those things, right?
So we have a problem with labor on EPC because a lot of labor is cross-district labor and some of it is cross-state labor. And there are restrictions, particularly in these hinterland states now, on movement of labor because COVID has spread from the metro areas now to little more to Bihar, UP, those kind of areas, right?
Right.
So there are restrictions on labor, so that is a reality. One of the things we've used the lockdown positively for EPC, because EPC, the work or execution of the work is only half the problem. The other half of the job is to really get all your reconciliation papers, approvals, documentation, reconciliation, all of that stuff done, okay? So we've actually used this lull to do a lot of that reconciliation, documentation, whatever preparation that otherwise normally, used to lag. So to that extent, that is helping us drive collections even in the absence of execution work. So in a way, we are yet not losing that time, but yes, execution is challenged because of the labor issue there. Yeah.
Right. Sir, one more aspect, about this entire supply chain, and there has been a lot of thrust by the government for local manufacturing, and obviously shutdown on imports. Now, I think in one of the interviews or one of the phone calls, you did mention, that your direct exposure to imports is fairly low. But, your entire supply chain will have significant dependence on imports. So what are your thoughts on, trying to have more indigenized production or manufacturing sourcing?
So we're already working on that, Rahul. That varies by product category. Lighting, LED related stuff, we already made significant progress on substituting China imports. On certain other consumer appliances, the timelines vary. We're already working on that. But between 6 to 24 months, most of it should be where we should have alternative, options for. Having created the alternative options, then we'll evaluate on how it works from a price, consumer choice perspective, etc. But it should not be a constraint for us, is the way we're looking at it. Yeah.
Okay. And that is not something which has affected the July.
No, so I think more than that, it's the local supply issues. So, example, it's not just our plants also operating under constrained capacity, but any product category has a long value chain. A mixer grinder has somebody making a jar, somebody making some rubber part, somebody making another plastic component. If any single component supplier is under containment, the entire production stops. So I think the supply disruptions are more local, both at a production level. Then certain warehouses come under containment and certain truck movements get restricted. Mm-hmm. So national supply chain kind of gets disrupted for that reason.
Okay.
So these are, I think if the local thing is sorted out, I think we are fine. So I would not, I'm just talking on relative concern for us. Yeah.
Sure. Now, my last
Mr.
question.
Gajare, I'm really sorry to interrupt, but maybe request you to rejoin the queue as there are several participants waiting for their turn.
Sure, thank you.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Dhrushil Zaveri from Aditya Birla Mutual Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. So the question was on debt, the target for debt by the end of March 21. So you've already seen 145 crore kind of debt reduction. And earlier, if I remember, you had said 300 crore plus debt reduction for FY21. So just wanted to get a sense, is that target still there, or has there been a revision there?
Let our CFO come in, please.
I think we are is still there. We'll say that our debt is reduced to 550 crores.
By the end of 21?
But
yeah.
Consolidated debt, including...
By March 21.
Yeah, March 21.
So this 810 will reduce to 500?
Yeah.
550 I would rather count on.
550.
Yeah.
Okay. Yeah, thanks. That's all for me.
Thank you. The next question is from the line of Chetan Ginoria from AlfAccurate Advisors. Please go ahead.
Hello, sir. Hello, Anuj. My question is with respect to the EPC business. Can you give us the breakup in terms of which are the key, what was the loss of the key 1 or 2 loss-making projects, and what was the rest of the EPC business? So can you break the EPC loss, say for FY20 or for this quarter, and how it will be going ahead?
So I'm not sure I fully understood, but let our CFO, address.
No, we don't give project-wise profitability at this. So there will be some projects making losses, some projects may be doing good, and obviously it's a contract accounting. So some of the provisions are there in the accounting. Tomorrow we may have to reverse if there is a change in raw material pricing or the same. So we don't really share all this project-wise data to outsiders.
And also,
Chetan, if I may, sorry, the chairman can go.
Also, frankly speaking, how do you divide the overhead? How do you, account for it? It's very difficult to say on a variable basis, margin basis. What is the basis of profit loss are you talking about? This extra business I did not do on a variable basis, it's making profit. But if I put the overhead, it doesn't make profit. So therefore, we don't go into that. We only say each project, are we able to complete it in time and collect the money? That's the cycle which is most critical. Cash flow is very important, and that's what we are working for in future. All new projects which we are taking, we are keeping a track of the cash flows, how fast the rotation will take place, so that our return on capital employed has to go up, which is just not negative. It's hardly any return you are getting because of this situation of a lot of money is getting blocked up. So that has to be cleared now. That's what we have worked on, and we'll see how things are.
Chetan, the other aspect for you to remember in the AS7 accounting, so the project level costing and revenue moves in tandem. Okay, the losses that you're seeing now is largely because of not the project level cost, but the overheads cost while the project's at a standstill. So the overhead is not getting absorbed, and therefore a lot of these are because of the standing cost. But the project revenue and cost typically moves in tandem and would get booked together. Yeah.
Okay, I understand. I just wanted to understand the UP loss, but I understand the difficulty. My question is, so EPC business, you said that from next year, Q1 probably will be able to completely reduce our losses and come to break on. Is my understanding correct in this respect?
That's our target, yes.
Okay. Thank you.
The next question is from the line of Mayank Bandari from B&K Securities. Please go ahead.
Yes, thanks for the opportunity. Sir, my question is pertains to your distribution. So Bajaj Electrical having one of the best distribution touch points across the country. So I was just, in terms of strategically, you should have gained some market share given that you have the largest number of touch points, but that does not reflect in your numbers. Like, I'm talking in terms of ECD only.
Now, how do
you thought around this?
How do you come to this conclusion that we have not improved our market share unless if we have shown a negative growth, we have to find out what our competitors have grown. So, unless if we have negative 50%, they are negative 60%, then we've grown market share. They've negative 40%, then they've improved market share. So unless we have the competition data, just because we are negative 50% doesn't mean that we've lost market share. You understand? It's very important to understand that market share is relative to somebody else's growth or not, degrowth. You understand that? So unless we have those figures, we can't come to a conclusion whether we've gained or lost market share.
Okay. So basically, we don't have any industry data as such to indicate that we have gained or lost, right?
So, Mayank, that also varies significantly by category. Even when competition you see, even if you look at the ECD segment, their mix of categories is very different. One particular player, for example, is in the male grooming thing, like right? So a lot of their current gain in this lockdown period has come from that. So similarly, if you look at different players, somebody has, I don't think washing machine is necessarily bundled in, but different players. So it is very hard to generalize market share at a overall, business level. Those are always tracked at a category level. But the second aspect, the way I see it is, all of us, which are the top 3-4 companies, would have gained market share right now versus the unorganized or unbranded players. So to that extent, I think there will or is being or will be greater consolidation. I don't have numbers to prove that, but if these unorganized players were reported, then I'm sure their drop would be more than this 50%. Yeah.
Okay. So there will be some consolidation for sure, and
in favor of the top 4 or 5 players versus the others, and within that, then category by category, it would vary. So yeah. I mean, I don't want to name players because it's not fair for me to do that, but I do have a view on which player has gained or lost in which product category. Yeah.
Also, let me add that there's another issue which comes up is that except for fans and lighting, there's at least a body like IFMA, which is Fan Manufacturers Association, and ELCOMA, which has some data. Appliances, there's no data available. It's all guesswork, or just you talk to competition and that's all you find out. So whether in appliances we've gained or lost, we can't say. Except by logic, we say if we've grown by 15 or 20%, we've gained market share, we think. But we can never be sure. Maybe somebody else has grown by 25%. So this is something which is, in India, unfortunately, there is no proper data to confirm whether we've gained or lost market share. We can only look at our own growth levels, which is important.
Okay. And sir, in terms of the margin expansion of 200 bits in ECD category, any guidance you can give us a full year for ECD margin?
So overall, my guidance remains 1% expansion at the operating margin level for consumer business. This year, if you leave quarter one aside, because that's an aberration at the bottom line, on a normal quarters, 1% expansion at operating margin level.
Thank you. The next question is from Tarang Bhanushali from Yes Securities. Please go ahead.
Yeah, hi. Good evening. So my question is largely related to the UP project. So what would be the revenue this quarter we have registered, and what would be the receivables from the UP project?
Mr. Purandre?
APC revenue, just a second. Yeah, APC revenue elimination, we did 58 crores. For distribution, we did 66 crores. And transmission line tower, we did 90 crores.
Okay. And for the
UP is within power distribution, but we don't split that up.
Okay. And what would be the receivables pertaining to the UP order?
UP receivables are in the range of 820 crores.
And sir, what would be the net debt level for us?
Net debt, because cash is just 12 crores.
12 crores.
Yeah.
Because it was almost 100 odd crores at the end of Q4.
March there was cash, because we conserved some cash looking at the COVID uncertainty. Now the cash as of June was 12 crores.
So sir, the net debt level reduction is low at the 60 odd crores?
So it is 183 is the actual reduction, minus the cash utilized is around 90 crores. So it will be around 90 crores is a net reduction.
Thanks a lot, sir.
Thank you. The next question is from Rahul Soni from SIMSS Limited. Please go ahead.
Hello. Yeah. Thanks for taking my question. Just one question from my side. Sir, what percentage of your revenue is coming from online sales, and what is the margin between the product you are selling to your dealers network channel and to the online?
So Rahul, I shared that earlier. Q1 is slightly odd to try and look at it at a quarter level on the contribution, because e-commerce online opened after the trade date, so it would not be a fair comparison. But just to give you a directional answer, traditionally it used to be in the 10-11% range of contribution from online. I think on a run rate basis now, let's say Q2 should be probably 13 odd percent, so about a couple of percentage point increase. but maybe some margin of error there. We don't disclose contribution of margins, for each channel.
So what kind of sales percentage you are seeing 2 years down the line?
If I may be honest, and I've said that before, we have our estimation, but publicly we don't have a bias, because to us all the channels are equally important. We make sure that we are available across all the channels and let the consumer make the choice, and we keep restocking or refueling it. So we don't want to take a view on which channel is favored. None of them are favored for us. Of course, you and I know that e-commerce will continue to outgrow the general trade.
Okay. That's all from my side.
Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Deepak Agarwal for closing comments.
Thanks everyone for joining, and thanks management for their valuable time. Sir, you have any closing remarks?
No, I would only say that thank you for joining this conference call, and we are very optimistic, positive. Actually, there are a lot of improvement and a lot of corrections that has been done. So this COVID is on one side, of course, we've lost out April, May, but overall, from a long-term point of view, we've become a much stronger company, and therefore you can see some better results coming in the future. With these words, I would like to thank you again. That's it.
Thanks everyone for joining this call, and thank you.
Thank you.